Okay, let me get this set up here. Okay, so this is a second part of the conversion debt, and basically what we're going to look at here is we talked about this paid in excess of par, paid in capital in excess of par, and so now we look at the standpoint of what happens when we have an induced conversion, which is basically like a sweetener. And a sweetener could be just some extra cash that we want to do. Maybe a company wants to get it off the books, and so because they want to get it off the books, excuse me, they're willing to offer a little sweetener to additional consideration to basically get the bonds off the books so that it's converted into an equity. So we offer what we call a sweetener. It's an expense in the current period. So let's just look at this example. We looked at this example in the last video. Everything's the same. We have bonds payable, we have the discount, we have the common stock, we have the paid in capital. And the only thing now is that Assume More wanted to reduce its annual interest cost and agreed to pay the bondholders $70,000 to convert. So all we would do is record this as an expense. And so we can call that a debt conversion expense. It's an expense we're allowed to take, and therefore we credit our cash as a result of that. Okay, so nothing out of the ordinary there. What happens when we retire convertible debt? Well, we recognize, same as retiring debt, that it is not convertible. The difference between the cash acquisition price and the carrying amount should be reported as a gain or loss in the income statement. So now, because we are retiring the bond, we're not converting it, we're going to record a gain or loss in the income statement, and so we're going to recognize it. So as a result of recognizing, obviously our profit could go up or our profit could go down. Okay? All right. Let's look at convertible preferred stock. What happens now? We talked about convertible common stock. What would happen if it's a preferred stock? It's very similar. And preferred stock includes an option for the holder to convert preferred shares into a fixed number of common shares. So we can say, okay, we want to take preferred stock and we're going to convert it into common stock. So we're not dealing necessarily with bonds, we're dealing specifically with the equity. We're not retiring. We're converting preferred stock and just simply converting it into a common stock. Why would we do that? Well, one of the reasons why we may do that is because preferred stock has some sort of, and I don't want to use the term guaranteed, but they have a higher priority of dividends received than, let's say, common stockholders. So we may want to get rid of that. The other thing is that the share price might be different between preferred shares versus common shares. Another reason might be because the company no longer wants to have any outstanding preferred stock within the company. So there's a lot of different reasons why that could be the case, but in any case, this is what we're looking at. How do we convert it? Okay, so basically we're going to look at this illustration, and we just see it right here. Gall issued 2,000 shares of common stock, $10 par value common stock upon conversion of 1,000 shares of $50 par value preferred stock. The preferred stock was originally issued at $60 per share. The common stock is trading at $26 per share. Prepare the entry of record. Okay, so the original entry is actually down here. Okay, so we look at this and we see that originally we would have debited cash. We had credited our par value of the preferred stock at $50,000, and we also would have had a credit of paid in capital in excess of par preferred stock of $10,000. I put APIC there. You guys know about my history with APIC. It's not APIC anymore. It's paid in capital in excess of par preferred stock, $10,000. Okay, so we have this $60,000. Now we're converting it. So we just simply reverse that entry, and now we record our common stock. Well, we know that our common stock is recorded at par, and the difference with that par is going to be the paid in capital in excess. So nothing out of the ordinary here. Common stock, we know, 2,000 shares at $10 par value, therefore it's $20,000. The difference, the plug, is that we have to get up to $60,000. Well, that difference is going to be the paid in capital in excess. Okay?